This is question number 7 of homework 1, problem 2, 23. Consider the following abbreviated financial statements for Western enterprises. We have 2 years partial balance sheet. We're given current assets for 2000, next fixed assets for 2016 and 2017, as well as the current liabilities and long-term debt. So what's missing here? It's the equity part, right, on the right-hand side of the balance sheet. That's actually the first part of the question is asking you what is the owner's equity for 2016 and 2017. Western, we also provided with the sort of a partial income statement as well. So part A, what was the owner's equity for 2016 and 2017? So how can we figure out the owner's equity? We can use the balance sheet identity, right? So balance sheet identity means that the total assets equals total liabilities plus total equity. So we are provided with the current assets and net fixed assets. So from them, we can calculate the total assets. And the total liabilities is simply the sum of current liabilities and long-term debt and plus total equity, which is owner's equity. So we can figure out owner's equity by the difference between the total assets and the total liabilities. So that's the approach we can take. So you can use different tools to solve this question. You can use a scientific calculator, you can use a financial calculator, or you can choose to use an Excel. So here I choose to use Excel. And what's convenient about Excel is if you read the rounding requirement, here is do not round individual calculations. And Excel, by using Excel, it automatically meets this requirement. And what's also good about using Excel is that you can actually directly copy these numbers into your Excel sheet. So here I just copy them and paste. So see what happened. So the numbers you can see that are all here. So you don't have to put these numbers, individual numbers into the Excel sheet. Here it's automatically provided. So the total assets, let's see the total assets. TA is simply the sum of its current assets plus net fixed assets. So this is for 2016, and you can just pull this up to right to 2017. So this number here, just delete all these intermediate values. This number here is simply the sum of the current assets, this number here and this number here. So, and the owner's equity, so that's the missing part, right? That's the missing part, which is what we are trying to get. But based on the total assets, we automatically know total liabilities plus owner's equity, right? Which is the same for 2016 is the same as the total assets, and for 2017 is the same as the total assets of the 2017. So these numbers are here, and owner's equity here is simply the difference. Now the difference between the total liabilities plus owner's equity minus the total liabilities, right? The total liability is simply the sum of the current liabilities and long-term debt. So this is the total liabilities for 2016, and just pull this to the right. So and erase the intermediate values, and this is simply the difference between. You can see it's the difference between the total liabilities plus owner's equity of 2017 and the sum of the current liabilities and the long-term debt of 2017. So that's so basically we just need to copy this number, owner's equity, back to our Excel sheet for 2016, and copy this number back to the owner's equity for 2017. Here, I'm not precisely sure whether the comma here can be accepted. So what I want to do is to check my work. Yes, that seems to be working. So we're good to go. So continue part B. What was the change in net working capital for 2017? So the definition of net working capital is simply it's the difference, right? It's the difference. So net working capital, where's my pen? Okay. So net working capital. Okay, so seems that something's wrong here. Erase it. And NWC equals current assets minus current liabilities. Right, so that's the definition of the net working capital. So here it's asking what's the change. So in order to calculate the change, we need to figure out the level first, right? The level of net working capital for 2017 and the level of net working capital for 2016. So we need to figure out the levels. So we're provided with the current assets, right, and current liabilities for both years, so we can calculate the levels pretty easily. So go back to our Excel sheet. The NWC, this is NWC. You see NWC for 2016 is simply the current assets of 2016 minus the current liabilities of 2016. And we do the same for 2017. Get rid of the intermediate just numbers. So you can see that this number is simply the F1, which is F5, which is the current assets of 2017, and N5, which is the current liabilities of 2017. So the difference change in NWC now is simply this 2017 level minus the 2016 level. So that's 59. So we just put this 59 here. And C1, in 2017, the company purchased 1830 in new fixed assets. How much in fixed assets did the company sell? So what's the in order to figure out how much the fixed assets the company sell, we know that the net change in the fixed assets, right? The net change in the fixed assets is simply the difference between the 2017 and 2016 level. But notice here it's the net fixed assets. The net fixed assets here is the gross fixed assets minus the accumulated depreciation, right? That's what the net here means. So if you only take the difference between these two, you're actually also including 1 year's depreciation. So that's why we have to use once you take the difference between 2017 and 2016, you also have to add back 1 year's depreciation, which is from the income statement. Right, income statement. We also copy this income statement here. So change in gross fixed assets. Why do I care about change in gross fixed assets? Because that tells me how much fixed assets the firm acquired in net over that period, right? The change in gross fixed assets for 2017 is simply how much over between 2016 and 2017, how much fixed assets the firm acquired. So that's why I care. So once you know that, because it tells you the company purchased this in new fixed assets, so then how much the company sell, and then the difference between the purchased fixed assets and the sold fixed assets is simply the net purchase of the fixed assets. And that's what this is about, the change in gross fixed assets. So that's why we care. So as we said, this is the difference between the 2017 level minus the 2016 level. But then don't forget about the depreciation over the year, which is from the income statement. So that's the change in gross fixed assets. And as we said, this change here is simply the, so let me write down this in my notes. So the change gross fixed assets is simply the, you should be purchased fixed assets minus sold fixed assets, right? So now the question is asking this is sold fixed assets. So from here we can say sold fixed assets is simply equal to this purchased fixed assets minus the change in gross fixed assets, right? If you just move this negative sold FA to the other side of this equation, so you change sign and then you move this change in gross fixed assets to the right hand side of this equation, and you also change sign, and then you become this expression. So it's purchased, and then the sold fixed assets is simply equal to the purchased. Purchased is right here, 1830 minus this change. So that gives you this amount, 203. So C-2. In 2017, the company purchased $1830 in new fixed assets. What was the cash flow from assets for the year? So it's the same setup as in part C1. Now it's just changing the question. It's asking you what is the cash flow from assets given the tax rate. So how can we figure out the cash flow from assets? And we know that the cash flow from assets is cash flow CFA is equal to what? Is equal to operating cash flow, right? Operating cash flow minus the change in net working capital, which we just did the calculation in part B, and minus net capital spending. So net capital spending is simply the change in gross fixed assets, which we just also did the calculation in this Excel here, right? Change, which is 1627 here. So the only unknown in order to figure out the cash flow from assets is this operating cash flow, right? This part. So Then in order to figure out the operating cash flow, we need to work on the income statement now. So from the income statement, we can see that we can actually add one line, EBIT, right? EBIT is simply the sales minus costs minus depreciation, right? That's the depreciation. That's the EBIT. So then add one. Oh wait, I don't have to add this. Okay. So then the EBT is simply the EBIT. So let me put here. Oh, the EBT is simply the EBIT minus the interest, right? Earnings before taxes is the earnings before interest and the taxes minus the interest. So that's the EBT. And then we can calculate the taxes. Even the tax rate is 35%, right? If you go back, double check the tax rate, yes, 35%. So the tax is simply the EBT is EBT multiplied by the tax rate. And then net income is simply the difference between the EBT and the taxes. So now with that, we can calculate OCF, operating cash flow, which is simply the EBIT, right? We start from EBIT, remember? Plus, we add back depreciation because depreciation is not a cash outflow. So we need to add it back, and then we need to deduct taxes. So that's our OCF. So now with this number, we can calculate cash flow from assets, which is OCF minus the change in NWC, which is here, and then minus the change in gross fixed assets, which is the net capital spending. So, and then that's my number. That's our number. 2563. Just copy the number here. And D-1, during 2017, the company raised $390 in new long-term debt. How much long-term debt must the company have paid off during the year? So this question is kind of similar to what we just did, because here we are provided with the new long-term debt. So it's asking how much long-term debt the company has paid off. And the difference between the new long-term debt and the long-term debt the company paid off is the net change in long-term debt. And the net change in long-term debt is basically we can get from the balance sheet, right? Taking the difference between the 2 years levels. So this question is quite, I think it's quite straightforward to figure out. So get the change. So let me get the change. So change in long-term debt is simply the level of 2017 minus the level of 2016. So that's the change. Again, this change is simply the change in long-term debt is simply new long-term debt minus repurchased or repurchased the long-term debt or paid off, right? Paid off the long-term debt. So now I know this I know this, the change, I know the new, so I can figure out the purchased. So 3 REP long-term debt is simply the new long-term debt minus the change in total long-term debt. So back to my Excel sheet, the new, this is the purchased long-term debt. This equals, the new is given by 390, or 390, yes, 390, minus the change in long-term debt. So that gives me 250, 250. So the last part of this question, D-2, during 2017, the company raised 390, same setup actually. What was the cash flow to creditors? So the cash flow to creditors, if we recall, cash flow, which I used B, for bondholders, creditors the same. So for them, they can have two sources of cash flow. One is simply the interest, right? For the company, the interest is an expense, but for the creditors, it's an income. So this is positive. And then the next source, the second source of their cash flow is the net issuance of long-term debt, right? So why this enters negatively? Because if the company issues a new long-term debt, for the company that connects money from the creditors, but for the creditors, for the bondholders, they actually have to pay the company. So that's why for them, the cash flow is negative. So that's why this enters as a negative value here. So the net issuance of long-term debt is simply this the same, the change. So this is the change in long-term debt. So that means we can actually calculate this pretty easily, right? Because we are provided with the interest. So cash flow B is simply it's the interest right here minus the change in long-term debt right here. So 40. Okay, so we're done with this question. Just check our work. It seems that I have used this for checking. So the only way I can check whether I did it correctly is simply to submit this. So let me do that and see whether I got the question right. So let me go back to question number 7 because we are working on that question. So looks like yes, we got every part right. Okay, so let me stop here.